Hey, everybody, and welcome to today's Tech Talk Tuesday. With me is David Blake, our resident expert, to talk all things technical analysis. David, how are you today?
I'm doing quite well, Rachel. Thank you.
Great. Let's jump right into how last week's market did.
We'll get kind of a volatile, kind of a choppy week last week. However, we did get the S&P 500 and the NASDAQ to snap their 3-week losing streak. That was kind of nice. Now, a lot of that was basically due to blowout earnings from Nvidia, which came after the close on Wednesday, which even for bullish investors in Nvidia, I think they were surprised to the upside. And that kind of sparked a reversal in equities on Thursday and Friday to close out the week, which was nice. But early in the week, what we basically got, we had some mixed earnings, especially in the retail side. I know Lowe's, Macy's, Dollar Tree, a couple other ones. Kind of their guidance was a little bit light, especially with Dick's Sporting Goods. Dick's actually was one of the first retailers to mention that theft was becoming a real problem for them that they were going to need to address. Dick's, I think, was down about 25-30% on the day. It was the worst day they've ever had in the market. And then I think on it might have been Tuesday, S&P Ratings downgraded a bunch of regional banks, and that took the financial sector down a little bit. I'm not sure exactly how far they were down, but they were one of the worst performing groups. So the banks are still struggling in here with these higher rates and all. And then finally, on Friday, we got Fed Chair Jerome Powell, which everyone was waiting for his little speech there at the Jackson Hole Symposium. And I call it his no surprises speech. He basically reiterated what he's been saying all along, that the Fed needs to be, they're going to watch the data, they're going to keep rates higher for longer. But he did throw in one caveat, and that was that the Fed was well aware that if they do too much, they could tip the economy into a recession. Of course, the flip side of that is if they do too little, we could see an acceleration again in inflation, which would also be bad for the market, which means they have to increase rates even more. So because of that, just the fact that the Fed's letting them know that they still think that there's soft landing may be the worst case, but the fact that he expressed that they are concerned about going too far. We ended up getting a nice little bounce on Friday, which was what pushed the NASDAQ and the S&P 500 in the plus column. The Dow Jones didn't quite make it. Even with a nice gain on Friday, it was still lower for a second week. So that's something that we'll have to see what happens today. The Dow is actually outperforming a bump up in 3M stock after they settled a lawsuit with the government on some faulty combat earplugs. But anyway, back to last week. Long-term yields were a little changed on the week. They swung up and down quite a bit. I think the 10-year Treasury actually got up to 4.35. Ended the period around 4.23. That's where we are today. I think it's unchanged as we're doing this. But we did have the 2-year T-bill nudged above 5%. It closed at 5.07%. So people are kind of watching that. Also, towards the end of the week, we saw crude oil prices inch back up to basically where they started the week. We're back up over $80 a barrel. And nothing too surprising there. That still goes along with our thesis that energy stocks are one of the places where you want to be right now, especially with some of the oil stocks going into the fall and winter here. Okay, as far as the market sectors go, last week they were mixed. Thanks to Nvidia, we did have a 2.27% spike in technology, which was welcomed after it's been struggling here. And then we also had strength in consumer discretionary. Part of that was due to gains in Tesla. And then REITs also, I'm not sure why, they outperformed a little bit. Now, on the downside was energy and consumer staples were the worst performing sectors. Again, but nothing to worry about on the XLRE. I think, again, some of the oil-related stocks were some of the are bouncing back. They're bouncing back again today. So they look pretty good on the charts in here, and we've been upgrading several of them also. As far as the technical condition of the market goes, it's still, if you look at the charts, we're kind of going sideways on a lot of them. Sideways, they kind of choppy trading. I think we're probably going to stay like that for the next couple of days. This week, actually it was on Thursday, after Nvidia reported its earnings, everything spiked up. But I noted on the in the market letter that the S&P 500 and the NASDAQ, and I believe, let's see, what was it? And the Dow Jones Transportation Index, they all rallied hard, but every one of them got topped out right at its 50-day moving average, which is what you'd expect as a key resistance level. I hit that, and they immediately bounced back, and the end of the day sharply lower. Friday again we opened up lower, but then we bounced back, but nothing big. Now today, what we're seeing, we opened up higher today, not on any real news, just maybe the fact that, as I mentioned, we were a little bit oversold in some of the different indexes. Today we also saw the Dow Jones trade up to its 50-day moving average, and the transports one more time, and that's exactly where they stopped. They hit that resistance, and traders, I guess, are selling that. The NASDAQ and the S&P and the SOX, none of them have made it up today to that level. So we'll kind of watch that. As I mentioned, basically we're in a little bit of a range with the major averages, and that's resistance on the upside at around the 50-day moving average, support down here at the 100-day moving average. And again, today we're basically trading in between that, in that range again today. Countering that jump in the S&P 500 and the NASDAQ was where we had the Dow Jones and the Russell 2000, which is a small cap index, and again also the transports. They actually on some of the sell-offs last week, they actually came down, but they found support at the 100-day moving average. So again, that just reinforces our case and confirms that we're going to stay in this little trading range to see what happens until we get a signal that we're either going to break up higher or we're going to break down a little bit slower. We had mentioned last week that we were looking for support around the Dow Jones at 3440 to 34120, and we actually got down to 3429 last week. So that was hit. Target on the downside, S&P 500, we had it around 4300 to 4320. That got down to 4340, which is not quite hit the target, but one of these things, if you're within 20 points, I think that's pretty good. So again, I think those ranges probably are in play as long as as we're staying in this little range. Underlying breadth last week, I wrote that it remains weak. The AD lines were, both of them lost probably less than 1,000 units, which is not a big deal. But we still have the 52-week lows are outpacing the new highs on both indexes. That's something to keep an eye on. That just means that you don't have a lot of big leadership on the upside when we do get a good day. As far as sentiment goes, we're starting to see some of the bulls get a little bit more worried here. We've had a nice year so far in the market. They're starting to maybe book some profits. We did have the retail clients, according to the American Association of Individual Investors, they're down for a third week, and we're down to only 32.3% of retail investors are bullish. That is below the historical average of 37.5%. And the pros, they keep lightening up on equities. They're the hedge fund managers now are only have about 34.4% exposure to equities, which is that's the lowest since October of this past year. So that's something to kind of watch. I think that's probably about the fourth week in a row that they've been lightening up. Remember, about sometime in July, the first July, they got to the point where they're actually going on margin, and then right after that, they've started to reduce pretty drastically from there. Just want to mention real quick on the summary from last week. We talked a little bit about what we have coming up, and this week there are some on Thursday and Friday. We do get some key reports out. That's going to be on the PCE and also on some jobs data from the Federal Reserve. I think ADP comes out with their jobs data on Wednesday also, and we get third quarter GDP. The other thing is that I think I mentioned last week in the letter that we want to keep an eye on the yields again. The yield in the 10-year Treasury is something that I think you would really want to focus on. Actually, Art Cashin was on CNBC on Friday, and he was pretty much saying the same thing. He's got a little smaller range than I have, but I think on the upside, we could stay in this range for a while until we get more data. But if the 10-year rate goes above 4.60, 4.65, some of that area, I think you're going to see stocks probably sell off at that point. And on the flip side, I think what you need to watch is somewhere between say 4.16 to 4.20. If we can, see the yield break below that level, I think we could see investors, especially stock investors, move into the market and start to scoop up some of these beaten down stocks. And again, I would expect the big cap tech shares to lead the way on that. So that's something to keep an eye on. And September is also it's usually a kind of a rough month for the market. It's pretty choppy trading. August is historically one of the worst also. So I think what we'll probably do is stay in this range up until Thursday or Friday. We start to get this data released, and that could if it comes in line, maybe we keep going sideways for a little bit until we get some more, maybe the CPI and the PPI coming out the following week. You may look at some of the figures that we put on the market letter. One of them is the momentum index, which we went to a sell on the market here a week or two ago, and the momentum index now is negative at -10. And the reason that is because the Dow right now is underperforming some of the other indexes. So we want to keep an eye on that. If the momentum index gets back up here to maybe it's a +2 or +3, then that would mean that we're starting to see some of the other indexes underperforming the Dow when it goes down to -10. It means that the Dow is kind of going sideways while the rest of them have been selling off. But if we see that momentum index pop up to maybe a +3 or +4, something like that, that would mean that the other indexes may have bottomed out or going to start to move. But the CTI is still in a negative configuration, and I still think we're going to see maybe some sideways to down action here over the next 2 or 3 weeks until once we get into October, then maybe I think we'll have a little bit more of an idea whether we'll get to that end of the year rally. Other than that, we've seen a real breakdown in the industry group, so it's pretty much across the board weakness in the market. It was just 3 weeks ago, 80 of the 91 industry groups that we follow were either strong or improving, and then last week that was down to only 26. So that pretty much tells you that again, basically across the board, you're seeing weakness in almost every sector. I will note that as of last Thursday, the strongest industry groups were coal, trucking, media broadcasting. Not sure about that one, why, and oil field equipment. So you are starting to get again some of these energy stocks that are still remaining strong despite this pullback in the market. So that's something we're going to look at. Let's see. Other than that, that's kind of basically what I have for today. I look for maybe some choppy trading in here, but we just have some information. We want some reports that are coming out towards the end of the week that maybe we'll get a chance to see the market head higher or lower from there. But up until then, I would just expect to see the major averages stay range bound.
Great. Well, thank you so much, David. We'll keep an eye on our market letters to see where the market goes for the rest of the week. Is there anything else you'd like to share with us this week?
Yeah, I will actually, when you go in there and you look at the daily comment, Richard does it on Wednesday. We will mention if we're starting to see, the yields starting to tick slowly higher or lower during the week. That's something that maybe we'll give you a little bit of a heads up. And one other thing I did want to mention that despite, we're still about an 85-90% chance of probability that the Fed's going to leave rates unchanged in September. I don't see any change in that. But we did see now the CME Group FedWatch now actually projects about a 50-50 chance of a quarter-point rate hike in November at the FOMC meeting. That's up from just about 30-35% just about a week or so ago. So they are thinking that some of these economic numbers come in maybe a little bit better than what we were expecting, that we could, maybe they need to fine tune their rate hikes a little bit as the year comes to an end. Quarter point's not going to make much difference. It's just, again, just some fine tuning that I don't think would make much of a difference to the market, especially if we are seeing the inflation numbers come down a little bit. But again, just look for some choppy trading in here. We'll keep you up to date on the daily comments if we see any changes. Let you know. Also, a lot of times we'll see negative, positive divergence in the breadth, and that kind of gives us a little bit of a hint as to which way traders and maybe the pros are leaning as far as what they expect out of some of these reports.
Sounds good. Thanks so much, David. Well, that wraps it up for this week. If anyone has questions, feel free to reach out at marketedge.com using the chat now button, or send us an email at support@marketedge.com. Your first 2 weeks are free, and we'd love to see you.
Okay, you have a good week.
You too. Bye-bye.